Okay, if you're feeling some serious whiplash from the markets lately, you are definitely not alone. I mean, after this incredible run up, we just witnessed a massive, massive financial reset. So today, we're going to deconstruct exactly what happened, why it happened, and most importantly, what it all means for you. And it all kicked off with this one number, -2%. Now, I know what you're thinking. 2%, so what? But this wasn't just any drop. It was the worst single day since April, and it was a huge red flag that something much, much bigger was brewing just beneath the surface. And then, at the exact same time, the crypto world gets hit by an absolute shockwave. We're talking about the largest single-day liquidation in its entire history. In less than 30 minutes, traders using leverage just got completely wiped out, lost everything. So the big question is, what on earth could possibly trigger such a violent, coordinated sell-off across both stocks and crypto? Well, according to the source material for this explainer, the answer, it comes down to a single word. A word that can send a legitimate chill down the spine of just about any global investor. And that word is China. Okay, so let's really dive into this because the relationship between the US and China, it's not just about trade, it's way more complicated. Think of it like a high-stakes global chess game where every single move, every little nudge has massive consequences for everyone. And this really shows you the delicate and, let's be honest, pretty imbalanced dance between the two. You've got the US relying on China for all sorts of low-priced goods. And on the flip side, China relies on American consumers, us, to buy all that stuff. But here's the kicker. The US buys way more from China than China buys from the US. That creates this huge trade deficit, which is a big structural risk just waiting to cause problems. And this timeline just lays out exactly how that tension boils over. It's a classic tit for tat. The US slaps on some tariffs, boom, China retaliates. So the US escalates. Then China plays its trump card, export controls on rare earth minerals. And literally the next day, the US hits back, announcing a plan for a staggering 100% tariff. You see how this works? Each move just triggers the next one, and the entire global economy is just holding its breath, waiting to see what happens. So you might be wondering, why are these rare earth minerals such a huge deal? Well, look at this. China processes 90% of them. And we're not talking about some obscure stuff here. These are the building blocks of all modern tech. The smartphone in your pocket, the computer you're watching this on, even advanced military hardware. It all depends on these minerals. This near monopoly gives China some absolutely incredible leverage in this whole economic chess game. But here's the thing, all that geopolitical drama, that was just the spark. The market itself was already a tinderbox. I mean, it was just packed with nervous energy, record high valuations. Basically, it was just waiting, looking for any reason to catch fire. And this quote from Graham Stiffen, who's the source for this explainer, just captures the mood perfectly. After one of the strongest 6-month rallies in history, people were getting seriously nervous. You know that feeling? The gains just felt unsustainable. It really felt like the market was operating on borrowed time. And the warning signs, man, they were everywhere you looked. Google searches for AI bubble, they hit an all-time record. Tech share of the entire S&P 500, it blew past the peak of the dot-com bubble. The Buffett indicator, a super famous way to value the market, hit its highest level ever. And under the surface, something even more worrying was happening. Credit scores were dropping at the fastest pace since the Great Recession. Okay, so this brings us to the one thing that turned a simple drop into a historic collapse: leverage. Especially in crypto, you can get something called 100x leverage. Now, what does that mean? It means for every dollar you put in, you're controlling $100. So if a coin goes up just 1%, you double your money. Sounds great, right? But if it goes down 1%, you're done, completely wiped out, liquidated. And this is where you see the absolutely devastating chain reaction that followed. That first little price drop, maybe just 1%, was all it took to wipe out that first wave of traders. And here's the key. Their positions are automatically sold by the system. That selling pushes prices down even more, which then triggers the next wave of liquidations. It's a domino effect, a liquidation cascade that literally vaporized entire fortunes in a matter of minutes. So, wow. With all this chaos and volatility, how is a normal investor supposed to navigate this mess? Well, the source for this explainer lays out a really timeless philosophy that just cuts right through all that noise. First things first, it's so important to understand the difference between investing and what has really just become speculative gambling. Real investing? It's kind of boring. It's calculated, it's long-term. It's not about the adrenaline rush of trying to beat the market or posting your weekly gains on Twitter. It's about slow, consistent growth over decades. And lately, that line has gotten seriously blurred for a lot of people. So this boils down to 4 core principles. Number 1, be prepared. Know that big market drops are going to feel terrible, and the best buying opportunities are usually right at that moment of peak fear, when everyone else is panicking. 2, be consistent. Good financial habits like saving and being frugal, they matter in every single type of market. 3, be humble. Overconfidence is an absolute portfolio killer. And finally, and this is maybe the most important, be patient. Just buy a broad index fund and hold it for decades. Yeah, it's boring, but you know what? It works. And if you need any more proof that trying to time the market is a bad idea, look at this. If you had just stayed invested for the last 5 years, you'd have a 15% return. Not bad. But if you panicked, sold, and missed just the 10 best days, your return plummets to less than 4%. And here's the crazy part. The market's best days almost always happen right after its absolute worst days. So, what's the big picture takeaway from all of this? It's really about reframing these huge, dramatic, headline-grabbing events. It's about learning to see them for what they actually are in the grand scheme of things, just white noise. And this table really helps put it all in perspective. You know that 5% drop that feels like the end of the world when it happens? On average, that happens about 3 times a year. A 10% correction? That happens about once every 20 months. See? These aren't some crazy, once-in-a-lifetime events. They're a totally normal, totally expected part of being an investor. There's one of the most famous sayings in finance for a reason, and it's this: the market can stay irrational a lot longer than you can stay solvent. What does that mean? It means you can be absolutely convinced it's about to crash, and it just keeps climbing. You can be certain it's finally hit the bottom, and it just keeps falling. Trying to outsmart the market is a game that can, and often does, cost you everything. So the ultimate takeaway here is pretty simple. If you're truly investing, your time frame isn't measured in days or weeks or even months. It has to be measured in decades. That's it. Only with that kind of long-term perspective can you actually ride out all these irrational swings and capture the real growth of the market. And all this leaves us with one final big question to think about. In a world that is constantly bombarding us with financial news, with panic, with hype, could it be that the most strategic, the absolute wisest move you can make is to simply stay the course?